The FOMC has a deepening conflict with its dual mandate. Let's take a closer look at that now with our chief equity strategist and economist, John Blank. John, what is the conflict exactly?
Yeah, Terry, I'm going to talk directly out of the summary of economic projections that the regional, parts of the Federal Open Market Committee supply. So it's a collection of what as the dot plots, but they work around a median and a central tendency. And this is the March 18th, production, which is about a month old. We won't get another one for another 2 months, but let's talk about where we're at. So the federal funds rate by the year end is they're looking at 3.4, Terry. In this projection, we're at 3.64 now. So there's only one rate cut for this year that they see. And the median production for 2027 and 2028, Terry, is 3.1. So they can't see anything more than two rate cuts for the next 3 years. So that's dramatically different than what most people think. And I will tell you the core PCE inflation rate, which they are concerned about, and is one of their mandates, is going to be 2.7% this year, which means they won't make it this year. They won't make it, and they'll get to 2.22% next year, and that would allow that other cut if we get the other half a point out. Here's the problem, though, Terry. Their mandate is for also full employment, and at this point in time, they get 4.4% for unemployment this year, 4.3 next year. But as everybody knows, Terry, there's no jobs out there available. So in the oil price shock scenario, we can have, profit margins plummet and that unemployment might rise. And that is the struggle here that is called stagflation, where you have high employment and high prices. And under the oil shock scenario, that is where we're headed.
Is there a compromise available to the Fed?
Terry, they're going to sit on their hands and let the oil shock play out for a few months. That's the compromise.
Any secondary concerns to all of this?
Terry, you have to worry about financial market instability. And, we've had this private credit debacle already this year. We've got, a lot of stress in the office markets from remote working. And all of this can, as if we do get a core PCE inflation rate that just keeps rising from downstream effects in the broad PCE inflation from oil shocks, this could spiral out of control. And actually, the 10-year Treasury, which is what they don't control as well, but they can control with quantitative easing, can rise and rise and rise. With a 5% 10-year, Terry, we're going to have a huge sell-off in stocks and a lot of financial stress.
So the inflation rate does factor into all this.
It absolutely does, Terry. And this is the problem. It's going to factor in a stagflationary way this time around if the oil shock sticks. That does mean high inflation and high unemployment. So when you get high unemployment and high inflation, that's called stagflation, stagnation and inflation. And that's just an awful place for the Federal Reserve to be and the U.S. economy to be as well.
I'm hearing you reference the Iran conflict. What's the impact from that conflict on this picture?
Well, we've got a blockade of Iran and the shutting of the Straits of Hormuz and, potential for missile and drone activity to destroy production facilities and shut in production facilities across the Middle East. So it's really, if the conflict is not resolved, Terry, it is a worst case scenario. Of course, everybody's expecting the conflict to be resolved, but we shall see, and that means we're got a few weeks, if not months, of very uncertain environments.
How does the FOMC respond to all of this? Have they expressed any thoughts?
Terry, the uncertainty is going to keep them on the sidelines, and that is, in some respects, the only solution they have until it resolves itself. The other problem here is, if you try to address the patient, which is the oil shock, with medicine, which is the monetary policy rate, it's not really the medicine the patient needs. So the bigger problem here is the patient needs the oil shock to go away, and that's a policy-related thing, mediation-related thing, military-related thing, not a monetary thing.
So you don't see them addressing this issue at all at their next meeting?
No, they will start to tell everybody exactly what everybody should understand, that monetary policy is not a solution to an oil shock, basically.
So in light of all of this, and given the state of uncertainty regarding our economy, what is your Fed rate policy outlook? Is it any different?
Nope, it's not any different, Terry. And I do fill out a form with the Atlanta Fed every month, and I am basically like the Fed, stuck, because you want a 1% real rate, And so if you have a 2.7% core PCE rate, 1% from that is 3.7. It's basically where we are, Terry. So in the absence of the core PCE inflation rate falling this year, they're going to do nothing.
Interesting. So, three large cap stocks, Zach's number one strong buy picks. We'll turn our attention to these three stocks that should keep traders' interests include Chevron, HSBC Holdings, and Advantest Corp.
Yeah, let's talk Chevron, Terry. I mean, of course, we've got the oil shock, and they're a major component in the oil integrated space, and they also are a component of the Dow Industrials. They're the only oil component. Share price 185. It was basically 150 just before the oil shock. It sold off a bit. They used to be about 210, a couple of weeks ago. But what we need to talk about is the annual earnings estimate revisions. That is the Zacks rank driven thing. And for this year, of course, it's 57% up. That's the oil shock. But what's more important in my mind is what the analysts, the covering analysts, the people who really know this business think. And that's 21% more estimate revisions next year. So what they're saying in Chevron's estimates for earnings is that we're going to get a sticky and long-term problem with this oil shock that's going to last next year. Whether you believe it or not, that's another issue, but that's the smart money, Terry, and that's what they're telling you.
HSBC Holdings.
HSBC Holdings, of course, this is Hong Kong Shanghai Banking Corporation, very old British conglomerate that has a lot of business in, of course, mainland China, particularly on the coast. It has been just rocketing up from 2024 at 40 to about 85. Now we've got a target price of $98 a share. So definitely some, I got a 91, I guess, to 98. We got a 10%, fair value lift from these earnings. And, the price earnings ratio, Terry, is 11. So probably a lot of momentum here, unless, of course, the same problem everybody knows about, China falls apart under the oil shock, then it's a totally different story.
Advantest Corp.
Advantest Corp, we need to talk about this as part of the AI trade. It provides automated test equipment for testing semiconductors. So when Micron and NVIDIA and other groups like Intel start to produce these high, AI high bandwidth chips, these are the guys that get tested for putting those chips into the data centers. It's just rocketing, Terry, from about $30 a share to I've got $175 a share, and we've got a target price of $200. So looking for a momentum trade in an AI trade that's, just got, weeks but not months left on it. Take a look at Advantest, ticker ATEYY.
Our chief equity strategist and economist, John Blank, on the Fed's dual mandate conflict. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.